In April 2023, the International Monetary Fund published its World Economic Outlook. In the main text, the report described China facing declining trend growth, property sector distress, and weakening consumer confidence. That framing was carried across nearly every major financial outlet within 48 hours. The same report, in its statistical appendix, recorded China's GDP at purchasing power parity, the measure that adjusts for what money actually buys in each country, at just over 30 trillion international dollars. The European Union's figure was 22.8 trillion. The United States was 26.2 trillion. Those numbers did not travel the same distance as the headline. Purchasing power parity is not an obscure academic construct. It is the IMF's own preferred measure for comparing economic size across countries with different price levels. The fund says so explicitly in its methodology documentation. When economists want to know which economy produces more steel, more food, more medical procedures, more infrastructure, PPP is the figure that answers that question. Nominal GDP in US dollars answers a different question. How large does this economy look when you convert everything into dollars at today's exchange rate? The answer to that second question changes every time the dollar moves. The answer to the first question does not. China's property sector did contract. Evergrande's collapse in 2021 was real, and its consequences for domestic credit markets were real. Youth unemployment reached a recorded high of 21.3% in June 2023, at which point the National Bureau of Statistics suspended publication of the series, a decision that tells you something about the sensitivity of the number, even if it tells you nothing about what the number would have been next month. Both of those facts belong in any honest account of China's economy. So does this one. Between 2015 and 2024, China's share of global manufacturing output rose from 26% to 32%, according to United Nations Industrial Development Organization data. An economy in structural decline does not typically expand its share of world manufacturing while that decline is being reported. That is the tension this script is about. Two things are simultaneously on the record: a sustained institutional narrative of Chinese economic fragility, and a sustained expansion of Chinese economic output by the measures those same institutions publish. They cannot both be the complete picture. One of them is doing more work than it should. What determines which figure leads the story is not methodology. It is which methodology someone chose to apply. And when you look at how that choice was made, a pattern emerges that the methodology appendices document rather precisely. The preference for nominal GDP over purchasing power parity in Western reporting on China did not happen by accident, and it did not happen all at once. It solidified around 2014 and 2015, the same window in which China's PPP-adjusted economy first drew level with the United States in IMF data. That timing is worth sitting with. In 2014, the IMF's World Economic Outlook data showed China's economy, measured by purchasing power parity, either matching or exceeding US output, depending on the precise quarter examined. The reaction from several prominent American economists and commentators was not to engage with the methodology. It was to question whether PPP was the appropriate measure at all. Lawrence Summers, writing in the Washington Post in October 2014, argued that market exchange rate comparisons were more meaningful for assessing global economic power. He was not wrong that both measures capture something real. He was also not a disinterested party. He had served as Treasury Secretary during the period when dollar-denominated GDP rankings placed the United States comfortably ahead. The argument Summers made is a legitimate one in economic literature. The problem is that it was not applied consistently. The World Bank's International Comparison Program, which produces the PPP benchmarks, had been used without significant controversy to compare European, Japanese, and emerging market economies for decades. The methodological objection arrived precisely when the ranking it produced became inconvenient. This is where the mechanism becomes visible. Western institutional reporting on China operates with two parallel tracks. When the data shows Chinese weakness, rising debt ratios, falling property values, contracting exports in a given quarter, The figures travel quickly and without methodological qualification. When the data shows Chinese scale, PPP output, manufacturing share, infrastructure investment measured in physical units, the figures arrive with caveats about reliability, state distortion, or the limitations of the metric being used. The IMF's own Article IV Consultation reports on China, the annual assessments the fund conducts of member economies, document both sets of data. The 2023 Article IV report on China runs to 41 pages. The property sector stress appears in the executive summary. The PPP figures appear in the statistical annex. Both are in the same document. They do not receive the same number of column inches anywhere that document gets reported on. Goldman Sachs published a research note in September 2023 titled China's Economy, Navigating the Transition. It projected slowing growth and structural headwinds. It also contained on page 9 a chart showing China's contribution to global GDP growth over the preceding decade, exceeding that of the United States and European Union combined. The chart did not appear in the summary section distributed to clients. The projection did. That is not an accusation of fraud. Analysts select what to emphasise. The question is whether the selection pattern, applied consistently over a decade, across institutions that do not formally coordinate, produces a picture that is systematically skewed in one direction, and whether that skew has consequences for the policy decisions made by governments reading those analyses. The countries that structured their China economic assessments around the declinist narrative through the late 2010s made specific trade and investment decisions on that basis. Several European governments, working from analyses that emphasised Chinese fragility, delayed or scaled back infrastructure and supply chain diversification programs on the assumption that Chinese manufacturing dominance was self-limiting. It was not self-limiting. The UNIDO data from 2023 shows the gap widened. What I find significant in this mechanism is not that individual analysts were careless. It is that the institutional incentive structure never required the forecast and the outcome to be reconciled in the same document. The forecast ran in the executive summary. The outcome data ran in the annex. No single report was required to explain why the two kept diverging. That structural separation is what allowed the narrative to persist through a decade of contradicting evidence. Not deception, but a filing system that never forced the question. The question eventually has to be forced. The conventional explanation for the divergence between the declinist narrative and the output data is reasonable, and it deserves to be stated fairly before examining what it leaves out. The argument runs like this. PPP figures are useful for certain comparisons, but overstate Chinese economic power in ways that matter for geopolitical and financial analysis. China's nominal GDP, denominated in dollars, is what determines its weight in global capital markets, its ability to service foreign-denominated debt, its purchasing power for commodities priced in dollars, and its financial leverage in international institutions, where voting shares are calculated on nominal terms. A country can have enormous PPP-adjusted output and still face genuine constraints when dollar liquidity tightens. The 1997 Asian financial crisis demonstrated that productive capacity does not insulate an economy from currency and capital flow pressures. On this reading, the emphasis on nominal figures is not ideological. It is analytically appropriate for the specific risks being assessed. That argument is correct as far as it goes. China does carry significant dollar-denominated obligations in its financial system. Its banks hold substantial foreign currency liabilities. Its property developers borrowed in dollar bonds, and when those bonds defaulted, the damage was real and the transmission into domestic credit markets was measurable. None of that disappears because the PPP figures are large. The problem is what the conventional explanation does not account for, and the gap becomes visible when you return to something from the IMF's own documentation that did not receive significant attention at the time. In 2021, the IMF's Fiscal Monitor published an analysis of China's fiscal space, the room a government has to spend without triggering debt sustainability concerns. The report noted that China's general government debt, when consolidated across central and local government entities and policy banks, was considerably higher than the headline figure suggested. That finding was reported widely. What was not reported with equal consistency was the sentence that followed it in the same paragraph, that China's net financial worth, assets minus liabilities across the consolidated public sector, remained positive because the liabilities were matched by state-owned assets of considerable scale. The debt was real, so were the assets backing it. Reporting the first without the second is not analysis, it is selection. The conventional explanation also struggles with the trade data. If China's economy were undergoing the structural demand collapse that the declinist narrative implies, the signature in the trade figures would be a falling share of global exports as domestic producers lost competitiveness and foreign buyers diversified away. Between 2018 and 2023, the period of peak declinist commentary, peak tariff escalation, and peak supply chain diversification rhetoric from Western governments, China's share of global exports rose from 12.8% to 14.2%, according to World Trade Organization figures. That is not a rounding error. Economies contracting under structural pressure do not typically increase their share of world trade while being actively decoupled from. The detail from Part 1 worth returning to here is the NBS decision to suspend youth unemployment data in 2023. At the time, it was reported as confirmation of institutional opacity, evidence that Chinese statistics could not be trusted when the numbers turned unfavourable. That reading is not unreasonable. But the same commentators who cited the suspension as evidence of data unreliability continued to cite Chinese nominal GDP figures, which are produced by the same statistical authority, when those figures supported the declinist case. The methodological skepticism was not applied to the measurement. It was applied to the specific data point that complicated the narrative. What the record tells me is that the declinist framework was never really a forecast. It was a prior, a conclusion adopted early enough that the evidence arriving afterward was sorted into it rather than tested against it. Forecasts get revised when outcomes diverge. This one absorbed a decade of contradicting trade data, expanding manufacturing share, and widening PPP gaps without producing a single prominent institutional reassessment of the core thesis. That is not how forecasting works. That is how a position is maintained. The strongest version of the conventional explanation accounts for real risks. It does not account for why those risks, tracked over 10 years, did not produce the contraction they were said to make inevitable. That gap requires a different explanation than the one currently on offer. The tension from the beginning of this script was never really about which GDP measure is correct. Both measures are in the IMF's own publications. Both capture something real. The tension was about why one of them consistently led the story and the other consistently appeared in the annex, and whether that pattern, sustained across a decade, reflected analytical judgment or something that functions like institutional interest. The resolution is not complicated once you read the sequencing. Western financial institutions, ratings agencies, and research departments are not neutral observers of Chinese economic performance. They are participants in a global capital allocation system in which the relative size and trajectory of the Chinese economy determines where money flows, which sovereign debt gets priced at what yield, and which bilateral trade arrangements carry political weight. An economy assessed as declining attracts different capital on different terms than an economy assessed as expanding. The assessment is not separate from the outcome. It is part of the mechanism that produces it. The IMF's own External Sector Report from 2022 documented that China ran a current account surplus of $400 billion, its largest in a decade, during the same year that institutional commentary was most concentrated on property sector stress and structural fragility. Current account surpluses of that scale mean the rest of the world was sending China more money for goods and services than China was sending back. An economy that achieves that while being reported as structurally impaired is not being misread by the market. It is being misread by the analysis. The World Bank's 2023 China Economic Update noted that Chinese household savings rates, already among the highest recorded for a major economy, increased further during the post-pandemic period. High savings rates in an economy with underdeveloped social insurance are not straightforwardly a sign of consumer confidence. The bank acknowledged this. But they are also not consistent with the picture of an economy whose population has lost faith in future income growth. People who expect their economy to contract do not typically save at higher rates. They spend down savings to maintain consumption. The Chinese household data points in the opposite direction from the narrative built around it. My honest read on this is that the China is declining thesis was always less a description of what the data showed and more a description of what several important institutions needed the data to show. That is a strong claim, and I am making it on the basis of what is documented. A decade of forecasts that diverged from outcomes, a consistent pattern of leading with the figures that supported fragility and annexing the figures that contradicted it, and an absence across major institutional publications of any formal reassessment explaining why the predicted contraction did not arrive. When a forecast is wrong for 10 consecutive years and the institution that produced it does not publish a correction, that is information. It tells you the forecast was not functioning as a forecast. What this means going forward is specific enough to be worth stating precisely. The countries that structured trade and investment policy around the declinist narrative are now facing a China whose manufacturing capacity is larger, whose export share is wider, and whose PPP-adjusted output gap over the EU has grown, not narrowed, during the period of predicted decline. The policy cost of that misread is not abstract. It is denominated in supply chains that were not diversified, in dependencies that were not reduced, and in bilateral agreements that were not renegotiated while the terms were still available. The IMF will publish its next World Economic Outlook in the coming months. The property sector data will likely appear in the summary. The PPP figures will appear in the annex. Whether the gap between those two placements finally attracts the scrutiny it has always warranted is an open question, but it is no longer a question without a documented history behind it. If this kind of primary source analysis is useful to you, the channel produces it regularly, and the methodology appendices are always worth reading before the executive summary.